Okay. Hello, everyone, and welcome to today's webinar on Investor Ready Legal Compliance Before You Raise Funds. I'm Ijoma SK, a graduate intern with Adjuned Legal, and I'll be your moderator for this session. And with me is Barrister Noma Grace, a corporate and tech lawyer who will be leading us through today's discussion. This webinar is part of our H2 2025 series, a legal deep dive series, a 5-month legal deep dive designed to help startups build safer, smarter businesses and avoid legal mistakes that derail growth. Getting investor ready isn't just about the pitch, your pitch, or user growth. It's about showing investors that your business is safe to bet on. It's about showing investors that your business is safe to bet on. And before writing any funds, they'll definitely want to check your ownership structure, the contracts, your licenses, and compliance. And if things don't add up, investors' interest would quickly fade away. Here's an example. In 2018, a London-based fintech startup called Zazu set out with a bold mission to make cross-border money transfers cheaper and fairer for Africans in diaspora. The idea was solid, the need was real, and investors bought into the vision. Millions were raised, the product looked sleek, and media even hailed them as the first cross border payment marketplace for Africans. But then by 2023, Zazu had shut its doors. Officially, they cited running out of capital, but then unofficially, the cracks ran deeper. Regulatory hurdles, shaky fundraising structures, and the hidden cost of scaling without a strong foundation. Zazu's story is a cautionary tale, along with many others like Leap Transit, Bento Africa, Groove Shark, and so many other startups that rarely fail because the idea is bad, but they fail because their legal, financial, and structural foundations aren't strong enough to hold investor confidence. A great product might win headlines, but if your ownership structures, contracts, licenses, or compliance does not add up, investors see risk and not an opportunity. And that's why being investor ready is more about the pitch. It's more than the pitch and it's more than the growth charts. It's more about proving your business is safe to bet on. Investors will always peek under the hood before wiring funds, of course. And if they find messy cap tables, missing founder agreements, or unprotected IP, what looks like momentum would quickly turn into hesitation. So, over the next 35 minutes, we'll unpack how to spot and fix common red flags that scare investors away. Secondly, clean up your cap table, your safes, and convertible notes. Then we'd also learn how to build and organize a data room and legal pack that speeds up due diligence. And finally, how to position yourself as truly investor ready. This session is specifically crafted for tech founders, entrepreneurs, and startup teams navigating Nigeria's or Africa's startup landscape. But the principles are universal and apply anywhere founders are building. So if you're ready to raise funds on a solid foundation, let's dive in. Over to you, Ma.
Good afternoon, everyone. Thank you so much, Ijoma, for that wonderful introduction. Even the examples on Zazu, that just goes to buttress our point that being investor ready is more than what the media portrays. If anything, it's what's about, but what is behind the hood, what is happening behind the scenes. So the big idea is very, very simple. When you prepare early, you don't just pitch with confidence, you also inspire confidence. And that really is the difference between getting a yes from investors and watching the opportunity slip away. But what exactly are these investor expectations? Well, the truth is, when investors look at startups, they aren't only considering, is this product exciting? What's the media hype on this product? Is the attraction real? The deeper question that investors ask is, how much risk am I taking if I put my money here? Because the truth is, risk takes many forms, whether that's market risk or execution risk or financial risk, etc. The thing is that the most obvious risk of all, especially when it comes to investors and investments and companies, is the legal risk. This is because a company might look great on the surface, but if its legal foundations are messy, it creates an information gap, an asymmetry in the information where investors can't be sure if the company owns these assets, if they comply with regulations, or if they won't even face claims in the future that drain capital. And this uncertainty, this back and forth, is what reduces an investor's willingness to contribute or to even commit funds, or it can even slow down your negotiations, or in worst case scenario, the deal ends outrightly. So that's why you need to understand your investor expectations. But what are investors actually looking at? I mean, when you say understand investor expectations, what are those expectations? What are they looking for? The very first thing that any investor checks out for is the founders and the team. Because at the heart of every startup is the team. Investors evaluate the capability, the track record, and the equity splits that you have. How good is your team at doing what they are supposed to do? They ask questions like, does the team have the right skills and the chemistry, the relational chemistry expected to execute? Are the incentives of the company and the incentives of the employees and their staff, are they aligned? Is someone likely to walk away? What's the relationship like between the parties? Is there tension? What is it like? The second thing that investors look at before they invest is your market, your product, your market, and the traction that you have in the market. Proof of demand matters. There must be proof that your concept, that your idea, that your solution is actually wanted in the market. Investors look for product market fit, customer retention, and healthy unit economies. These signals all show that they are buying into a sustainable business, something that is actually needed by the market in general. The third thing that investors look at is your financial management. Money discipline is a must. If you cannot handle money, if you cannot handle or control where money comes from and how it goes out, investors will look at you like you are not ready. The investors, they expect clean financial books, they expect tax compliance, they expect a clear bond rate, and they expect realistic forecasts. So when you have missing or messy numbers, these all make investors nervous. And when investors are nervous, obviously the deal goes down. The fourth thing that investors look out for or that they expect is your technology and your product. For tech startups, the product is under a microscope because they are checking if every single aspect of your product does exactly what you say it does, without hitches and without breakdowns. They assess the code base, they assess your architecture, they assess your technique, the technique with which you build that system. They check your dependence or over dependence on third party tools, because if your product is built on a shaky foundation, then the entire thing comes crumbling down. Because if there is an issue, even the slightest issue with your product, then you have nothing to market to people, and so therefore you have no way of making revenue with which to pay back or to repay the investor's investment. So you can see how that is an issue. The fifth thing that they look out for, obviously, is legal and compliance. And this is really where many startups stumble, because once you mention legal to any startup or to any founder, they start to shake and they're like, oh, this boring thing. But that's the beauty is in the details. And so investors expect that your documentation is up to date and that they prove lawful incorporation, accurate cap tables, IP ownership, customers, supplier, employment contracts, your regulatory licenses, tax filing, and the absence of any hidden or potential lawsuit. Increasingly, especially in this day and age, data and privacy compliance is also very, very important. Now, here are some, now that you know what the investors are looking out for, what are some questions that they are likely to ask? The very first one is, well, can you show us your cap table and your stock ledger? Are there any outstanding shares or options not reflected here? Who legally owns the IP? And do you have signed contracts for all of your contractors? Are there any pending litigations, claims, regulatory notices, or tax assessments that you have not done and are doing in the present? Have you complied with all your sector specific licenses and data protection rules? If you cannot answer these questions confidently with documents or things to back them up, then there's a problem somewhere. There's a real problem somewhere. And this shows you, or this tells you, that there's work to do before facing investors. But now that you understand the investor expectations and the reason why being investor ready is critical for the success of your fundraising or your fund round or your funding round, what exactly goes on in a legal due diligence? What are the common legal red flags that you need to watch out for? And how can you make sure that you fix them or plug those holes before they end your investment track before you even begin? Well, the very first thing is a messy cap table, because during due diligence, they look at your documentation. And so the very first thing they look at, as I said earlier, is your cap table or your stock ledger. And if it's messy or you have undocumented equity flying around somewhere, then where do they even begin? How do they know that you, in fact, do own the company that, like you said, that you do? Your cap, for those of you that are unaware, your cap table is like a scorecard of who owns what in your company. It's the equity split. So it shows person A owns X percent, person B owns, and on and on and on it goes. So to be able to fix this red flag, you need to reconcile and update your cap table regularly. Attach any and all supporting documents to each entry and resolve gaps when there are buybacks or amendments or there's new resolutions, or even if you take out a piece of your an option pool for ESOPs, it needs to all be reconciled and updated in your cap table. The second legal due diligence red flag that you need to fix and fix very fast is unassigned intellectual property. Whether you've had conversations with founders, developers, and they left, or even if they are still working, and you don't have documentation to show that the intellectual property being built or being developed actually belongs to the company, there's a problem somewhere. Because someone can rise up in years from now and wake up and say, wait, I actually built this thing, and so therefore it's mine. What do you do then? Because now it becomes a situation of your word against theirs, and you can see how messy that already is. The third thing is missing or unclear founder or shareholder agreement. I have seen many, many, many times when two friends enter into they start building something together and they're like, we're friends, we'll deal with it later. Uh-uh. Later turns into when there's a dispute and you're like, I hate you. And then you start fighting, and all of a sudden the company breaks apart. Why? Because you did not take the appropriate steps to have a founder's agreement before you started that. Because with a founder's agreement, you are able to manage your expectations. So you know who is contributing what and when. And so to fix this legal red flag, please, if you're building with anybody at all, make sure that there is a solid agreement in place. The fourth thing that is a legal red flag during due diligence is material contracts that have restrictive clauses in them. I've seen this time and time again where people sign contracts and they don't even read it. Really, they really don't read it. And then when a lawyer goes through a dispute or something else is happening, and a lawyer goes through it, you find that there's many or even one or two things that are restrictive in that material contract. That's not good for business. That's not good for investors, because it shows investors that they are walking into a recipe for disaster. Because when those restrictive contracts come into or clauses come into play, then the investors' hands will be tied, because this is something you entered into before they came into the company, and nobody wants to enter into that. The fifth thing is regulatory or licensing gaps. If you're in a sensitive industry, say maybe fintech or insurance technology or health tech or even privacy, cybersecurity, things that have to do with people's lives or aspects of people's lives, you can see how where you have missing licenses or you have not complied with any of the regulations can become a real issue. So how do you fix this gap? Identify all the regulatory compliance requirements that you have, especially within your sector, and start to comply with each and every one of them. Do not leave any stone unturned. Then there are also employment and contractual liabilities where startups will misclassify their staff, or they'll skip having employment agreements, or worse, they won't even pay the employee taxes or the pension contributions or anything like that. Don't do that. Don't be part of the startups, or don't be part of the statistic of startups that do that, or that don't treat their employees well, whether in law or in actuality. Don't be that. The seventh one is poor bookkeeping and non-compliance with taxation and tax responsibilities. Whew. it goes back to mentioning the financial management. If you do not manage your money well, it shows up in every single aspect of your company, both in the bookkeeping and in your compliance with tax. So, therefore, money discipline is very important, even with your taxes, because when you have your taxes up to date, it communicates to investors that you are indeed on top of your game and you are serious about doing business in the country that you are doing it in. Then we have data protection and cybersecurity weakness. Whew. Okay, if you are operating in the tech world, which I would assume that you are if you are on this call today, then you would know that cybersecurity and data protection and digital strength are very, very important to your business, to your product, to your technology, and to your users. Because if anything goes wrong, say there's a bug and data gets leaked, or there is a breach, or something happens, and you lose data, or its data is mismanaged, or maybe it's even people's funds or their medical records or anything like that, that is a disaster. And no investor wants to be aligned with such a thing. So these are all the red flags that pop up, especially during due diligence. And these are the many, many, many ways that you can fix them. So now that you've understood what the investor expectations are, and you've understood or you've learned right now about the many red flags that come up during legal due diligence, what exactly is the cap table? What are safes and what are convertible notes? These are part, not all, but these are merely part of the documents that are required by investors, and they are investment instruments as well. Let's start with the cap table. As we earlier mentioned, cap tables are like scorecards basically of who owns what in your organization. So they just tell you exactly that they're like it's like a ledger of every single person that owns any single thing in your company, whether it's in the ESOP pool or whether an investor, there was an angel investor that gave you guys money when your product was merely an idea, or even if you've gone through many funding rounds, all of it is contained in your cap table. And at a glance, it should show you who the shareholders are, how many shares each person holds, what's reserved in the option pool, if you have any, if there are any convertible instruments, whether that is a safe or that is convertible debt, or even the percentage of each person's ownership, whether they are full, whether they are basic, or whether they are diluted at any level. Now, there are, with the cap table, as simplistic as it might sound to you, there are still mistakes that people make with it. And what are those mistakes? When you have multiple or conflicting records. I need not explain to you why this is already a disaster. Because when you have a cap table, which is basically a scorecard of ownership, why should there be duplicate copies? Why should there be multiple copies with differing details on this? Why should the multiple copies differ? Why should there be conflicting records? The next mistake that people made or make is having informal share transfers. Imagine you go out with your friend now, or it's an advisor or somebody that you met or someone that is already working with you, and you guys are having tea or having dinner or whatever you guys are out for. And then you're talking and you make a handshake deal saying, oh, I will give you X percent of equity. And then after that handshake deal, you forget to add it into your cap table. And so this person bears in mind that he has this percentage of equity in your company. But in fact, it is not contained in any of your books. How do you defend that? Because now it becomes your word against his. The next mistake is unissued or backdated options. Imagine going back to the very same example. You had something with someone years ago, maybe like 2 years ago, and for whatever reason, the person no longer works with you. The person has left the company, or you guys had a falling out, or whatever happened, and the person is no longer in the company and has forfeited or cancelled their equity ownership. And yet, their name is still written in the cap table. Explain that. So these are just some of the many, many mistakes that people often make in their cap tables. And you can see that having these mistakes in something as important as your cap table can turn away any investor that is looking to put their money into your business. The next investment instrument is a safe. A safe is literally a simple agreement for future equity. So it's an agreement that allows an investor to put in their money. It's typically an angel investor. But anyways, they put in their money into your company for the option to have equity in the future, or for the option to buy, no, not buy, they've already given you money, but for the option to have equity in the future. Maybe when there's a funding round and you raise funds, or maybe when you IPO, or maybe when you otherwise restructure. The point is, they bought equity, they gave you cash, or they gave you money for the option to have equity in the future. And obviously, through their equity, their monies get repaid. Now, typically, every safe converts into equity based on pre-agreed terms, typically using either a discount, which allows the safe holder to purchase shares at a reduced price when conversion occurs, or a valuation cap, which sets the maximum company valuation at which the safe will convert. This valuation cap ensures that the safe holder is not disadvantaged if the company's value has risen significantly. The key attraction with, after knowing all this, you have to understand that the key attraction for any safe is in its simplicity and its founder friendliness. It avoids the need for lengthy negotiations over valuation, especially in the early stages of a company, and it allows any startup to raise money really, really quickly. However, the tricky part, in because because it's simple doesn't mean you have to be careless with it. The tricky part is in how the conversion works. This is where terms like pre-money save or post-money save and cap versus discount comes in. And what do these terms mean? Well, a pre-money save calculates conversion before taking into account the impact of other safe agreements or new financing. And this can result in investors receiving less ownership than expected when multiple safes convert together. On the other hand, a post-money save fixes the investor's ownership percentage after conversion, thus giving that investor greater certainty. The trade-off is that founders often face heavier dilution than anticipated. Now, the next, a convertible note. Convertible notes are debt instruments. So you see how saves, simple agreements for future equity, is someone giving you money in exchange for future equity. Convertible notes, on the other hand, is someone giving you money as a loan for future, that will then turn into equity, or that will then convert, or they will be paid back that money after or upon certain events. So that's the difference. One is money for equity, the other one is money as a loan. Convertible notes typically accrue interest and they have a maturity date, just like a loan. And if it hasn't converted by maturity, it remains debt and may require repayment or renegotiation. Convertible notes are a form of financing that starts as a loan and later converts into equity. Investors lend money to the company today. The loan converts into shares when a defined event occurs. And when that conversion trigger is met, the debt, that is principal plus interest, is converted into shares at a price determined by the note's conversion formula. If no qualifying financing happens by the maturity date, that note remains debt and the company may and sometimes will have to repay or renegotiate the payment. Like safes, convertible notes usually convert at a discount or at a price derived from a valuation cap. However, they are appropriate when investor wants a debt protection, because typically in any company, if there is a winding up or you've declared insolvency or bankruptcy or anything like that, then the creditors are usually the priority. They are taken as priority because you have to clear whatsoever debt you own in the company before the founders, the staff, the shareholders, and any other person based on priority will be attended to. So sometimes some investors prefer these protections that a debt offers. Moving on quickly, guys. After we've understood cap tables and all the investment instruments that there are, and we've understood the common red flags that can be found during legal due diligence, what are other legal pitfalls and mistakes to avoid? Because founders run into trouble not because their safes or their convertible notes or any other investment instrument is bad per se, but because they don't track these investment instruments, or if they don't track them, they don't draft them properly. But Here are some of the most common traps, some of the most common pitfalls and mistakes that startups make unknowingly. The very first one is an unclear trigger for conversion. Like we mentioned earlier, safes and um, convertible notes, or really any investment instrument, they have certain triggers when they would convert into equity or into monies for the investment. And so if the triggers are unclear, if the agreement does not properly define what counts as qualified financing, disputes can easily, very easily arise over when the conversion should happen. Because now one person is saying it's supposed to happen here, and another person is saying so. The dispute automatically causes a wedge between all the parties. Then, if there is an ambiguous language on the cap or even a discount, what happens then? So, as a startup, it's always important for you to spell out that the investor gets the better of the two and clearly state how a conversion price is and will be calculated. The third mistake is when you mix investment instruments into one another, or especially when you mix them without modeling them. Multiple instruments have different caps, different discounts, different interest rates, and these all together can stack into unexpected dilution of a founder or a shareholder shares. So it's very important that as a startup, you run the math, you do the math, you model it into the future, you run scenarios in advance to see how much ownership will be lost once a safe or any other investment instrument converts into shares. You have to put the numbers on paper to avoid any surprises or to avoid any issues down the line. Another mistake is interest handling. For convertible notes, you need to specify whether accrued interest converts into equity and how it is calculated. When you have ambiguous clauses around interest, this can increase your dilution unexpectedly. Dilution simply means when your ownership percentage in the company gets smaller because more shares are created and given to investors. You may still hold the same number of shares, yes, but the percentage shrinks and the value of the shares also shrink, or the value that you can get from the shares also shrink. And you want to avoid that, or avoid, it shrinking to such a detrimental level as much as possible. Other mistakes are in ignoring pre-money and post-money differences. As a startup founder, your job is not just to ensure that the product is fit for purpose. Your task or your responsibility is also to know the appropriate terms, to educate yourself on how to run a corporation. And that includes understanding the terms and the terminologies that fly around. And so you need to understand one of those terminologies include pre-money and post-money. What is the difference between the two? Because the two versions, both pre-money and post-money, they produce very different dilution outcomes. And so you need to even understand what they are so that you can understand the effect of them in your company. Other mistakes include not showing convertible notes or any other investment instruments on the cap table, no clarity, not having any clarity on liquidation preference or rights post conversion. Again, back to that knowledge on running a corporation and things about corporate law. These are part of the things you need to know about. Then, not the last, but another mistake that startups make is regulatory non-compliance. Even small instruments can trigger securities law. So you need to understand which of your investment instruments can be considered a security or an asset. And so when you understand that, then ensure that there are proper filings and board approvals for each and every one of those securities or investment instruments that you use. Now, let's go into my favorite part of this entire webinar, which is your data room and investor starter pack or investor legal pack. Your data room is basically a compilation of all of the documents that your startup has or uses or needs in the ordinary course of business. It's a well prepared data room and even a neat investor legal pack. They are among the most effective ways to turn investor interest into real momentum, because they're not just a collection of documents, they are a signal of discipline, professionalism, transparency. The fact that you are able to arrange each and every document that your startup uses in the ordinary course of business, enough for someone else to easily log on to and view. That shows an incredible amount of professionalism in business. And for investors, the core question is always the same: is this risk acceptable? And when everything is clear, when all your documents are clear, they are indexed, they are easily accessible, then you find that the answer to the question, is this risk acceptable, starts to come faster to them, because now for every question that they have ways of ticking off and getting the answers, because they can see what you have, the operational documents that your startup has and uses. What goes into your data room is different depending on the stage that your company is in. For early stage companies, for instance, now the most important items that ought to be in your data room are like your corporate and governance documents. So anything from your incorporation certificate to your MEMAs or your articles of association to your board resolutions to anything really that is an incorporation or a governance document. Then you also need to have your cap table, obviously, in your data room. Then you have the material contracts, you have your intellectual property, you have your financial information, all contained in your data room. And as your company grows, as it grows through its several stages, as it successfully passes several funding rounds, then you need to have more and more documents, such as your audited accounts, detailed forecasts, regulatory approvals, employment and contractual agreements, litigation or dispute resolution histories, insurance coverage, data protection compliance, and on it goes. In fact, instead of you guys having to stress to think about what documents need to be in your data room, we have actually done something good for you guys. We have compiled all the documents that you need, especially as an early stage startup. We have compiled all those documents for you and put it into a singular checklist so that you can just print it out and plug it into your company without doing anything. And you can get the link to that startup data room checklist in the description box below. So please, guys, go straight down to the description box below and get that startup checklist right now. Anyways, moving on. How do you structure and organize your data, and what are some of the best practices that seasoned startups and corporations use to organize their document folder? Well, the very first thing is you need to have a logical folder structure or even an index. Someone needs to be able to find something and find it quickly. They don't need to scroll through different names or names that look alike or file names that don't bear any resemblance to the content of the document. They don't need to do all that. That's a hassle. So arrange it properly. The second thing is have an executive summary of all of the documents in there. Have like a 1 or 2 page memo or profile of your company and the documents contained in the data room, so that someone can look at that at a snapshot and see every single thing or get a clearer understanding of every single thing that is in there all at once. Standardize file formats and names. Use a virtual data room so that anyone from anywhere in the world can easily access it. Have protect sensitive documents so that people that don't have access to it don't get to see your trade secrets or your confidential information. And have a tracker that tracks where each and every document goes to and the processes or the stages that it goes through, from drafting all the way to viewing and reviewing, and on and on and on the trail goes. Now, what are investor legal packs? You might say, well, data rooms, investor legal packs, they sound like the same thing. Why should I care to have one and have the other as well? Well, your data room is a compilation of all of your company's operational documents, all of it from top to bottom. That's what is contained in your data room. Your investor legal pack or your investor starter pack, on the other hand, is a document or is a set of documents that you give to an investor when they first approach you. It's not the entire data room, just a few select documents that you give to them to give them a snapshot of what is happening in your company. And obviously, you won't give everybody everything, so it's dependent on who needs it, when they need it, and why they need it. But why do both of them matter? Well, like I said, having a data room and having an investor starter pack or an investor legal pack is all about credibility. Is all about credibility. Investors are putting money into a company that they don't yet control. So they need assurance. They need to be assured that the foundation of this company within which they are investing is actually strong enough to carry that money and bear fruits or give them returns on their investment. And so you find that a well prepared legal pack opens the door, while a well organized data room builds investor confidence, it builds investors' trust, and it accelerates the due diligence process and gets you one step closer to having that money in your bank account. And so you find that when everything is transparent, when everything is accessible, all of your negotiations move faster. Legal costs are reduced, and the company positions itself as a serious investor ready business. And so, guys, at the end of the day, you find that raising money is not just about convincing investors that your product is exciting. It's also about proving that your company is built on solid legal, financial, structural, and regulatory foundations. So, and when you have a messy cap table, or you have missing agreements, or you have disorganized record, this can undo months and months and months of pitching, or even following up, or even investor hunting. It can undo it because it takes one question for them to bring your house of cards crumbling down. But on the other hand, when your documents are complete, your ownership is clear, your data room is well organized, you don't reduce this risk. You eliminate it entirely and you project credibility. You basically, the investors are now, they begin to ask and to beg you for them to drop their money with you so that you can help them get certain returns on their investment. And you find that the best fundraising conversations, they happen when all these legal doubts don't get in the way of business discussions. Investors will feel very, very confident giving you money because your legal and your structural foundation is tight. Being investor ready means more than having a great story, or having product market fit, or being in the media eye, or being hailed in the media or in public news as having achieved something monumental. It's more than the paperwork. It's more. It shows the structure and the discipline. It shows that you have the structure and the discipline to back all of those metrics up. So when you do the work early, you raise faster and on better terms and with fewer headaches down the road. So that's why at all times and always, you should always be investor ready, even when your product is merely an idea, even while you are just starting up, even when the ink is just dry on your CAC registration documents. You must always be investor ready because you never know. Thank you so much, guys. Over to you, Joma.
Thank you
Hi,
very
Joma. Over
much,
to
Barista
you.
Norma, for breaking this.
Hi, Joma. Over to you.
Yes, thank you very much, Barista Norma, for breaking this down so clearly and practically. And I really learned a whole lot myself. And thank you to everyone who tuned in and engaged with us today. I hope you take action right away. And just like Barista Norma said, we have the startup data room checklist, and these resources, they are available in the description below. We have the startup data room checklist, just like you said, a guide for you to check your documents, for you to know what investors actually need before funding your startup. Then there is the startup self-assessment quiz, a quick test to see how legally prepared your startup is. Then there's the webinar notes. That's a written guide, a simple practical summary, basically a summary of what we did today's session that you could revisit anytime. Then we would also have ready the webinar replay link, which would enable you to watch the session again. And then, most importantly, we would invite you to the Founders Newsletter community. This is an exclusive space where we share legal strategies, startup insights, and regulatory updates that directly affect your business. I mean, for you to be in in line with the legal space. You have to be updated with what's going on in with regards to regulations and all. And all of these resources, just like we said, they are in the video's description. And before we round up, we would love to hear from you. What was your biggest takeaway from today's session? We would love it if you share it. Feel free to drop it in the comment section or share it on LinkedIn using the hashtag InvestorReady and Adune Legal. This is just the second session of our H2 2025 Legal Deep Dive series, and we will be back next month with another practical webinar designed to help you build smarter, safer, and stronger businesses. And on behalf of myself, Vice Noma, and the entire team of Adun Legal, we thank you for joining us today. And until next time, build smart, stay compliant, and be investor ready. Thank you so much.